Hi, this is the monthly macro monitor for Alhambra Investments for July 2019. And let's bring Joe Calhoun in because, Joe, we've got some things to talk about, not as much as normal. There are some things that I would call kind of boring at this point. But the one big thing that you pointed out in your report, you said we're not there yet. And it seemed in the second quarter that everybody in the world jumped on the recession bandwagon. And as we do at Alhambra, if everybody's talking about it, we're running the other way, right?
Yeah, that's pretty typical of us. I got to thinking about, the old, go on those car vacations when you were a kid. Are we there yet? Are we there yet? And look, it's, people got very excited about the yield curve inversion that happened in the second quarter. We had the 10-year 3-month curve inverted slightly for a very short period of time, and people got all excited. But I wanted to kind of address that because I think people forget how long it takes for these things to happen. I mean, we look back on them on a chart or something. You look at a chart in Fred, the economic data portal from St. Louis Fed, and it looks like, it's this tiny little thing. It's just that much. Yeah, but that was, 8 months. so I think we kind of forget as we move forward. We forget the last time we did this, and it takes a while for these things to develop. Like, I'm not saying we're not headed for a recession. I don't know. Eventually we'll get one. We're not there yet, though, as you said. We're just not there. I don't have enough evidence to make that kind of call.
Well, I think the other thing that happens here is that there are lots of yield curves. The ones that we watch is the 10-2, and like you pointed out, the other one was 10-3 months. And I'm not sure that everybody has jumped on the yield curve bandwagon really knows what to look at and what's accurate and what's not.
Well, look, I mean, the 10-year 3-month curve has also been a precursor to recession. Inversion of that curve has been a precursor to recession. The 10-year 2-year, which is the one I use. And listen, it's not just coincidence or it's not just, happenstance that I use the 10-year 2-year. I use the 10-year 2-year because the 10-year part is obviously going to be the same no matter what curve you're looking at. Although I do know people that look at 30-year versus 10-year and things like that. And there may be some information in there, but quite frankly, I think it's pretty small. Look, I use the 2-year on the short end for a good reason, I think. Look, if you use a 3-month bill, all you're getting there is Fed expectations. And it's going to be volatile because Fed expectations can change on a dime. I mean, look at today. Today, everybody's been talking about the regional Fed surveys. Oh, my gosh, these things have been coming down. They're awful. None of them are negative yet, really. Well, I take that back. No, some of them have turned negative, but not significantly. So this morning we get the Philly Fed survey, which, beats expectations by 4 times. They're expecting a 5, they get a 21. So, Fed expectations can change a lot in a very short period of time. So using the 3-month to me is just too volatile. I use the 2-year because there's some expectations there for real market stuff as well as some expectations of the Fed. So you get a little bit of both. But like you said, there's lots of curves and listen, I'm becoming more and more convinced that we've spent so much time talking about this that it just doesn't have the value that it once had. Like I mentioned the Heisenberg principle, and that's the idea that by observing something, we change it. And I think that's maybe true here. I mean, everybody knows about the yield curve. Now, I've been in this business for 30 years. The first 20 of them, I take that back. The first 10 of them, I had no idea what a yield curve was. I won't say the first 20. The first 10, I didn't know what a yield curve was. I was a stock jock, man. We didn't pay attention to yield curves. That was some bond guy thing. We didn't do that. So now everybody knows about it. The internet's changed things.
Well, recession, it's coming. It always is. When you finish one, you're headed into another one. But let's talk about something we do know. The economy is slowing down. And I don't think a lot of people know that because stock market made some new highs last week. But we've been watching that since mid-2018.
Yeah, look, we saw this coming. I mean, it was not rocket science here. I mean, first of all, we have Jeff Snyder out there watching these money markets for us, which is a wonderful thing because Jeff sees all this stuff before everybody else does. Sometimes I wonder if he's got X-ray vision or something, but he's Superman in some ways. But look, we started seeing these disruptions in the Eurodollar market over a year ago. And we know that those things, just one little ripple in the Eurodollar market doesn't mean that, the whole world global economy is coming a cropper. So, we watched it and it kept getting worse. There's a liquidity issue offshore. It's not new. I mean, it's like the fourth time in this cycle we've been through this. But from a different perspective, I was also looking at it and saying, look, we're going to slow down back to trend. Because what happened was we got the corporate tax cut and the other various fiscal changes last year, but they're one-offs, they're one-time things. And the change on the personal income side in particular really wasn't that significant. I guess one could argue that the pass-through and the 20% deduction on the pass-through was a big deal, but I don't know if it really was. Bottom line is we got this one-time pop and we got up to 3% last year, 3% growth, but we didn't change anything. We didn't change population growth. We didn't change productivity growth. Those things take a long time to change. And if you don't change them, you're not going to change your growth rate. So I assumed that we would fall back to the trend. Trend's 2.5. So we went a little to 3. We're pulling back. It's not a shocker. It's exactly what we expected.
Let's talk about one of your favorite indicators, the CFNAI. Little movement there this time.
Yeah, Chicago Fed National Activity Index, which is an amalgamation of a whole bunch of other indicators. Look, it's exactly what we expected. We're at a slightly negative number on the CFNAI. A 0 number on CFNAI means you're growing at trend. If you're positive, then you're growing above trend. If you're negative, you're below trend. We're a little bit below trend, minus 0.17. It's just not that big a deal. To get a recession signal, you've got to have a 3-month average of a minus 0.75, and we're not even close. So we're growing slightly below trend. That's consistent with what we've expected of the economy pulling back to that trend level growth of 2%. Again, not shocking, just not a big deal. It's exactly what we expected.
Well, let's move on to production. Some numbers that you looked at that you mentioned in the report from the Chicago PMI.
Yeah, Chicago PMI was the big standout kind of outlier. It was a negative under 50. I say negative. It was under 50. Under 50 on these things are diffusion indexes. So under 50 means it's a negative, and above 50 is a positive. A lot of people take those things as expansion and contraction, but that's not exactly true. It's true of manufacturing maybe, although the Chicago PMI actually includes services too. But when people look at these things, they think, oh, under 50, oh my God, we're in recession. Well, no, that's not what it means. You got to be somewhere in the low 40s, somewhere around 45, 44, something like that to actually be in recession. But anyway, we hit a 49, I think, 49.7, just under 50 on the Chicago PMI. But you know what? I got to tell you, the Chicago PMI is the most volatile one of these things that we follow. It's all over the map. And yeah, it covers a big chunk of the Midwest, and that's an important part of the economy, but it's only part of the economy. And we do know, too, that Chicago PMI is very sensitive to manufacturing, and manufacturing is what's slowing down in the economy. The rest of the economy seems to be okay. It's manufacturing that's really having a problem. So it's not surprising, but it was a negative report. The rest of the ones in this category, Philly Fed, Empire State, ISMs, yeah, some of them were less than expected, but they're all positive. Again, just a little bit lighter than where they've been, consistent with what we expected of the economy slowing back to trend.
Well, let's jump from manufacturing over to inventories, because inventories are going up, but in this case, that's not necessarily a good thing.
Well, inventory is rising in the second quarter, just as they did in the first quarter. Look, one of the things that, people, if you go back and if you look at our report, in that very first section, you'll see a line item that says real final sales to domestic purchasers. It's up only at 1.7% in the first quarter. That's really what the domestic economy is doing. That's sales. Inventories add to GDP because they're considered investments. Yeah, sort of. Investments in inventory are much more volatile and not productivity enhancing. Here's the deal. Inventories are rising. More importantly, they're rising relative to sales, which means that at some point, companies will cut back production and sell out of inventory to get inventories back in line. Look, there's some wild cards here too. We don't know how much of this inventory stocking, and look, inventory to sales ratios are back to levels not quite as high as they were in 2016, but they have definitely risen. It's not a positive sign. But there's some wild cards here. This trade stuff really kind of distorts this stuff. We don't know. We know that companies stockpiled stuff ahead of the tariffs, and they're continuing to stockpile stuff because we don't know what the Trump administration is going to do. Are they going to raise the tariffs on China? Well, there's a couple of different ways companies can address that. They can move their supply chain and go manufacture in Vietnam or someplace rather than China, and some companies are doing that. The other way to get around it, again, that's not a costless, frictionless thing to happen, right? You're going to move your supply line to Vietnam. It's going to take time. So what do? Well, you stock up in the meantime. So that's part of what's going on here, but I don't know how big a part. Sales certainly on the wholesale side have not been that great. Wholesale sales last month were only up 0.1%, and inventories were up more than that. So your inventory to sales ratio did continue to go up. Anyway, look, it's not positive, but I don't know how negative it is.
All right. There were a handful of things that were really, I may be off base, but I'm going to say really no big deal this time. You had consumption, factory orders, inflation, employment, and housing. Anything you want to say about any of those categories?
Well, the one that's most negative is factory orders. Factory orders did come in negative again. Factory orders and durable goods orders are kind of part of the same group of reports. We've seen some negatives there, there's no doubt. A big chunk of those negatives, though, has to do with Boeing. 737 MAX is still sitting on the ground, and they've had orders canceled now. And Boeing actually hasn't booked any new orders in several months. So durable goods orders and factory orders definitely have been hit because of that. If you take out transportation, they're slightly positive. Automobile sales have been still running the 17 million rate. So that's not slowing down that much. We've seen some rise in delinquencies on kind of subprime auto loans, but again, I don't know. I don't know why anybody would be shocked by that. So I don't know. Yeah, it's somewhat negative, I suppose. Within that report, that we do get the core capital goods report, which was positive for the last month. That's good news. I mean, it's not, again, not hugely great news because we had negative numbers prior to that, but it's better than another negative. So, look, consumption has been kind of punked the whole expansion. Retail sales are still rising, consumption is still rising, but it's growing at a kind of a slow rate. But that's been true for this entire expansion, so that hasn't really changed. Housing. I've been saying for a while, I think housing is going to have to pick up because population is still continuing to grow. We've talked about that. Population growth is not what it used to be. We're only growing at 0.6%, I guess, or something along those lines. But it doesn't really matter. 0.6 when you got almost 330 million people. 0.6 is a pretty big chunk of folks, and they're going to have to live somewhere. So I still believe that housing at some point is going to have to pick up. Construction is going to have to pick up. Right now, we seem to be kind of stalled a little bit. I've seen a lot of kind of, breathless headlines, but oh my gosh, housing is slowing down. Well, nah, not really. It just kind of stopped getting better. And we're still kind of at the low end of what we would expect for housing starts and new home sales and construction and so forth on the single family side. Multifamily continues to be pretty good. That's not as big an impact on the economy as single family is, but it's still a positive. Again, it's just kind of mixed. We're going through this mixed period here. We don't know how this is going to come out, right? We go through a mixed period. What's the outcome? Well, we either go into recession or we don't. We don't really know which way that's going to go yet. It's just we're kind of in the middle right now, and that's what the economic stats reflect.
Well, and we're in something of a bubble here in Nashville because things are just blowing and going here. Interest rates have come down. More people are able to buy houses, buildings going all over the place. But I'm not fooled by that. I know that that's not the case all over the country.
Well, Nashville is kind of a unique place, but I actually think it's an interesting thing. Let's go on that for a minute. Let's do some freestyle here, Bob.
All right.
We'll go away from the standard report here. I think what's happening in Nashville is very, very interesting. We've seen really kind of a boom in that whole area. It's what are the counties there, Bob? There's two or three counties.
Nashville is Davidson County, and then surrounding it is Rutherford, Williamson, Wilson, Sumner.
That whole area, though.
Yeah,
it's not just Nashville. It's not just, in other words, it's not just Davidson County. It's the surrounding area too. It's the whole area is growing, and you have a much better feel for that. Tell us about some of the things that have been going on there. I know that Amazon has come in there. So what else is going on?
Yeah, I mean, Amazon's coming in. They're building 2 huge towers, bringing 5,000 jobs to town. Mitsubishi just said that they're leaving California. They're bringing their corporate headquarters here. The state government is actively pushing, and so is Texas. But Tennessee and Texas are out in New York and California trying to round up mostly corporate offices because that's what brings the high-paying jobs. This is IT and healthcare management are the 2 top job creators here. Of course, Vanderbilt University and Med Center, that's 44,000 jobs across Middle Tennessee. There are about 25 cranes on the Nashville skyline right now. I mean, building is just going on everywhere. So it's a fun time to be here.
And that's not even to mention the music business, which is still pretty important to Nashville.
You know, it is, and that's changed over time because everybody thinks of Music City as country music. And now then, you've got all genres that are here.
Oh, absolutely. One of my favorite musicians, Jack White, is based himself there. And he's actually out on tour right now with the Raconteurs. He's just, all over the place in Nashville. But there's a lot of, you're right, every genre is there. And I think what's really exciting from a music standpoint, you know me, I love music. One of the most exciting things is that we're seeing these genres are starting to mix. One of the most popular songs in the country right now is kind of a mix of a rap and country song, which is just kind of strange. A mix of a rap and country song done by a gay guy. Are you kidding me? Okay, whatever. It's a great thing. Let's lead that in, though. I think it's interesting. Look, first of all, I don't think it's coincidence that companies are moving to Tennessee since they have no state income tax.
Yeah, that's exactly right.
But there's more to it than that. It's not just that. I think there's some other things going on too, and something I've noticed. Both of us, you and I both have been spent some time in Asheville, which is another place that's grown a lot. And North Carolina does have a state income tax. We've also seen a lot of growth in Greenville, South Carolina. And in fact, South Carolina was one of the fastest growing states population-wise in the country last year, and they have a 7% state income tax. Mm-hmm. So it's not just the fact that Tennessee has a low tax environment. That's a big part of it. But I think bigger than that is that I think this idea that everybody's going to move to a big city and live in this urban areas, that new urbanism that everybody's been talking about, I got to tell you, I never really bought into it, and I don't buy into it now. I think in a lot of ways, listen, I live in a big city, and I'm getting ready to leave. I'm tired of it. It's just too many people here. I live in Miami.
Will Miami throw you a farewell party?
They're not going to, well, I don't know. Probably more like, don't let the door hit you on the way out. We've seen an increase in population here of 500,000 people over less than a decade. And, we're in gridlock. You can't do anything. My point is that quality of life means a lot. And I think people are underestimating the attraction of moving to a place like Nashville or Greenville, South Carolina, or Asheville, North Carolina, or Myrtle Beach, or Charleston, or Augusta, Georgia, or Mobile, Alabama, or Birmingham, Alabama, or I'm running out of places. Little Rock, Arkansas, maybe. Well, Little Rock, maybe not so much. But anyway, my point is that I think what we're going to see is the opposite of what a lot of people are expecting from a demographic standpoint. Listen, you can go to an Asheville or a Greenville, South Carolina now, and you can get all the amenities that you would get in a big city. You've got great restaurants. The food scene, if you're a foodie, man, the food scene in Greenville is just blowing up. And here's a little tickler for all you big city folks who are imposing things like rent control and so forth, trying to figure out how in the world do I get these housing prices down. Got news for you. You can buy a lot of house in Nashville, Tennessee for what you could get in New York City or LA or San Francisco or Chicago. Same thing is true in Greenville, South Carolina, or Aiken, where I'm going to move to, or Augusta, or wherever you want to go. You got a lot of house for your money. And I think that quality of life, particularly millennials, everybody said, oh, they can't afford a house. Well, you're right. They can't afford a house in New York. They can't afford a house in San Francisco. Well, they can barely afford a parking spot in San Francisco. But they can move to Nashville and buy a house. They can move to Asheville and buy a house. They can move to Greenville and buy a house. They can move to Charlotte and buy a house. Lots of places in the South that are very welcoming and very affordable. So I think it's going to be interesting to see how that develops. I suspect there's an investment opportunity there for people who are willing to go into some of these small and mid-sized cities, particularly in the South, maybe some in the Midwest too, but certainly in the South is what we know. I suspect there's some opportunities, some real estate maybe opportunities in those areas that could be very, very interesting. So,
well, it is a fun time here. So I'm sorry that you're going to Augusta and you're not going to come up here and
well, no, it's okay, man. I got to get back to South Carolina, man. I've been away for a long time. It's time to go back. Anyway.
Well, one last thing we'll mention. I know you've got another report coming up today. This one is going to be market indicators. We won't be doing a video about that, but in 15 seconds, what's in the market indicator report?
Well, look, I'm not going to do another video because we covered a lot of the yield curve stuff in this report. The opening sequence here in this report was really about the yield curve, and I wanted to cover that because I think it has had kind of a lot of misinformation out there. But when I look at other market indicators, and one of the ones I highlighted here in this report was credit spreads. Look, we just don't see the stress that we would expect to see in U.S. markets if we were on the verge of recession. Look, we have seen short-term rates have come down, and real interest rates have come down too. TIPS yields, 10-year TIPS yields down to about 33 basis points. But I would, everybody that's out there scrambling and saying, "Oh my gosh, we're on the verge of recession," I would just ask them this question. The 2-year note has definitely come down in yield, but if we were really on the verge of recession, do you think it'd even be where it is? I mean, it wasn't that long ago that the 2-year was trading close to zero. If we were headed for recession, I got to believe that the 2-year note would be the 2-year note yield would be a lot lower. It's a slowdown. It's what the market's telling us. It's a slowdown. It's not disaster. By the way, that 33 basis points in the 10-year TIPS, look, it doesn't sound great, right? But you know what? It's better than zero. And that's where we were, say, in 2016. That TIPS number was at zero, which essentially that's a proxy for real growth expectations. Not a very good if it's at zero. It's not great at 0.33, but it's better than zero. So I think everybody needs to calm down a little bit, see where this goes. We don't know how it's going to come out. Everybody got all excited because the yield curves got flat. I'll leave you with one last piece of the market puzzle. In 1994, the 10-year, 2-year curve got to 15 basis points, almost inverted. Oh my goodness. Didn't get recession until 2001. That last 15 basis points was tough. And not only that, by the way, we inverted the 10-year, 2-year curve in 1998 and still didn't get recession until 2001. So these things, again, we're not there yet. It takes time. So be patient.
The most positive thing we can say, and it is definite, recession is coming sometime.
Yeah, someday.
All right. Thanks, Joe. And for those of you who'd like to read all of Joe's report, here's the address. And Joe, you keep a watch out for everything.
Thank you, Bob.
Thanks.